March 19, 2023. The trading floors of New York, London, Frankfurt, Tokyo, Zurich, and Ottawa are dark. No cameras. No press conferences. No emergency sirens. Just quiet. In Washington, D.C., a thin spring rain taps against the windows of the Federal Reserve. In Basel, Switzerland, home of the Bank for International Settlements, lights remain on well past midnight. Secure lines are open. Documents are reviewed. Language is debated carefully. Every word matters. Then, almost simultaneously, a statement is released. 6 of the most powerful financial institutions on Earth, the Federal Reserve, European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, and Bank of Canada, announce a coordinated decision. Permanent, unlimited, instant, standing currency swap lines between them, available at a moment's notice, with no expiration date. To the public, it sounds technical, boring even. A footnote in a Sunday news cycle already crowded with headlines. They call it precautionary. But history tells us something uncomfortable. Central banks do not build permanent emergency infrastructure unless they believe it will be used. And they do not coordinate at this level unless the threat is systemic. Here lies the paradox at the heart of this story. If the global financial system is stable, why prepare for its failure? This is not the first time the world's monetary authorities have acted quietly while assuring the public everything was under control. In fact, every major financial collapse of the last century followed the same pattern. Private coordination first, public reassurance second, crisis third. The architects of this system, central bankers, treasury officials, financial regulators, rarely speak in dramatic terms. Their language is deliberate, understated, and sanitized. But behind that language lies a different reality. A system held together not by strength, but by confidence. And confidence, once lost, does not return easily. To understand why March 2023 matters, we must step back, not years, but decades, and examine how the modern financial system evolved, how it became increasingly fragile, and why the people entrusted with its stability are now preparing for scenarios they refuse to name. Because what happened in March was not a reaction. It was a signal. Currency swap lines are not new. They are a mechanism that allows central banks to exchange currencies directly, bypassing markets during times of stress. In theory, they exist to provide liquidity when private funding channels freeze. But historically, swap lines were temporary. 2008, introduced during the global financial crisis. 2020, reactivated during the COVID market panic. Each time, they were described as emergency measures, short-term bridges across extraordinary events. March 2023 changed that. By making swap lines permanent, central banks acknowledged something they would not say aloud. Financial stress is no longer exceptional. It is structural. This decision came just days after the collapse of Silicon Valley Bank, the failure of Signature Bank, and the forced takeover of Credit Suisse. Events that exposed how quickly confidence can evaporate in a digitally connected banking system. Deposits now move at the speed of an app notification. Panic spreads faster than regulation. Gold, the silent vote of no confidence. While central bankers spoke publicly about transitory inflation and resilient growth, their actions told a different story. Between 2022 and 2023, central banks purchased 2,262 metric tons of gold, the largest accumulation since the late 1960s. Gold does not generate yield. It does not depend on counterparties. It does not default. It is what institutions buy when trust erodes. China, Poland, Turkey, India, and Singapore were among the largest buyers. Many of these nations share one concern: overexposure to a dollar-based system increasingly weaponized by geopolitics and debt. This was not speculation. It was preparation. The BIS and the backup system. In July 2023, the Bank for International Settlements unveiled a project known as Internet. On the surface, it appeared to be a technical vision for the future of finance, tokenized assets, interoperable ledgers, programmable money. But buried in the documentation was a critical phrase: operable during periods of financial instability or infrastructure disruption. In plain terms, a system designed to function when existing systems cannot. This is not innovation for convenience. It is redundancy for failure. Rehearsing the collapse. Since 2020, U.S. regulators, the Federal Reserve, Treasury, and FDIC have conducted annual simulations of major bank failures. Not isolated failures, simultaneous ones. The 2023 exercise assumed a sudden loss of confidence across multiple systemically important institutions. Liquidity dried up. Markets seized. Contagion spread. This is not contingency planning. This is rehearsal. The Treasury market, the crack in the foundation. The U.S. Treasury market is the backbone of global finance. It underpins collateral, pricing, and trust. And it has already failed twice. March 2020, liquidity vanished. The Federal Reserve intervened with over $1 trillion in purchases. October 2023, another breakdown during routine auctions. Quiet intervention followed. A market that requires constant support is not liquid. It is dependent. History rarely announces itself when it turns. There are no alarms, no official declarations, no admission that a system built over decades is approaching its limits. Instead, history whispers through quiet meetings, technical language, and decisions that only make sense when viewed together. What we have seen is not a single policy choice or even a series of isolated actions. It is a pattern, and patterns, more than promises, reveal intent. Permanent currency swap lines. Record gold accumulation. Backup financial infrastructure. Annual rehearsals for simultaneous bank failures. Repeated emergency interventions in the world's most important bond market. None of these actions on their own proves an imminent collapse. But taken together, they tell a far more revealing story. The institutions responsible for maintaining financial stability no longer believe stability can be assumed. This is the central paradox of our time. Publicly, central banks speak of resilience, normalization, and controlled outcomes. Privately, they are building systems designed to function when trust breaks down, when market sees, when liquidity disappears, when confidence vanishes faster than policy can respond. This is not conspiracy. It is institutional behavior. And institutional behavior is shaped by memory. Central banks remember 1929, when coordination came too late. They remember 1971, when confidence in convertibility evaporated overnight. They remember 2008, when interbank trust collapsed in hours and nearly brought the global economy with it. They remember how quickly modern systems unravel, not gradually, but suddenly. The world today is more interconnected than at any point in history. Capital moves at the speed of light. Depositors no longer stand in lines, they click buttons. Markets no longer pause for reflection. They react instantly, algorithmically, without emotion or patience. In such an environment, control is an illusion. Stability exists only as long as belief persists. And belief, once questioned, does not fail politely. That is why preparation matters more than reassurance. That is why the most important decisions are now being made quietly, technically, and with minimal explanation. Not because the public cannot understand them, but because understanding them would force uncomfortable questions. Questions like, what happens when debt can no longer be absorbed without consequence? What happens when the safest market in the world requires constant intervention? What happens when confidence in institutions weakens at the same moment alternatives emerge? These are not hypothetical concerns. They are structural ones. Gold purchases are not about profit. They are about insulation. Backup systems are not about innovation. They are about continuity. Permanent swap lines are not about confidence. They are about containment. This is how large systems adapt, not by admitting weakness, but by quietly rerouting around it. And yet, there is a final truth history makes unavoidable. No system can be stabilized forever by architecture alone. Systems endure because people trust them. When that trust erodes, mechanisms can delay the outcome, but they cannot prevent it. We are living through a transition, whether acknowledged or not. a shift away from assumptions that defined the last half-century, that liquidity will always be available, that markets will always function, that institutions will always be believed. What comes next may not resemble collapse in the dramatic sense. It may arrive as fragmentation, parallel systems, regional alignments, gradual changes in how value is stored, transferred, and trusted. But transitions of this scale are never neutral. They create winners and losers not by accident, but by preparedness. The unsettling part is not that central banks are preparing. The unsettling part is that they are preparing alone. The public is told the system is sound, even as its foundations are quietly reinforced. The language of reassurance remains, while the architecture beneath it changes. And history warns us what happens in these moments. Those who rely solely on official narratives are always the last to adjust. Those who observe actions rather than words see the shift earlier. This story is not about predicting dates or forecasting disasters. It is about recognizing signals, subtle, technical, and deliberate, that reveal how those in power perceive the future. Because when institutions that define stability begin to plan for instability, the prudent response is not panic. It is awareness. The question left hanging is not whether the system will change. It already is. The question is whether you will recognize that change while there is still time to understand it. History does not repeat, but it rhymes. And the rhyme is growing louder. What happens next will not be announced. It never is.